Focus. Ideate. Innovate. Enable.
That was quick.
Yeah, Ma, don't worry. I'm driving on the new expressway and it's absolutely safe.
Welcome to the second edition of PwC Presents The Winning Leap in association with CNBC TV 18. This is a show where we take a look at how businesses create value, discuss the strategies and opportunities that are vital for their growth, and the various challenges they face in India's economic environment. This week, we discuss the deal scenario in the country and what has made India an attractive destination for M&A activities. Taking the discussion further, I have with me Pramod Menon, Finance Director at JSW Energy, and Mr. N. Sivakumar, Leader, Deals, PwC India. Gentlemen, thank you both very much for joining in. Shiv, if I can begin with you, the first half of this year has already seen deals worth about $30 billion, M&A deals worth $30 billion being done. What is driving this?
So if you really look at the landscape, Prashant, you see largely this $30 billion is coming out of large ticket consolidation happening in the financial service sector and in the telecom space. And it's happening for two reasons. One is for getting a better consolidation play. The second one is to achieve dominance in the space you are in. We are seeing players coming together to achieve scale and be relevant in that space.
Mr. Menon, in your sector, where there is a lot of activity happening, I mean the infrastructure space in general, what is driving this?
I think currently the infrastructure space has to go through a consolidation phase. And this current level, I would say the consolidation is coming through primarily on account of deleveraging and certain amount of stress. The sector is, I would say, ripe for consolidation, and what we are seeing is partly driven by, again, in terms of scale and efficiency, companies trying to consolidate their positions. And lots of them, as I mentioned today, is a stress-induced or deleveraging-induced M&A activity which is more prominent.
Do you see what's happening in the infrastructure space spreading to other sectors as well? And what will, which sectors do you see this kind of spreading to in a big way?
So from a deleveraging point of view, I mean, infrastructure is a big one, which is actually you're seeing a lot of consolidation happening to de-stress the situation. But other sectors, even in something like textiles, also we are seeing, where and power sector, where you see a lot of debts accumulated, and the same theme is following, where people want to restructure to deleverage.
Let us say it will be de-leverage slowly going in for a more conventional kind of an M&A deals which is going to happen as far as this
need-based expansion, etc.
That kind of thing. Anyway, there will be a conscious need to consolidate as well.
So the so-called chronically stressed sectors, I mean the consolidation and the M&A in that space, you think that is mostly the peak is behind, or?
What we are seeing is a lot of more propensity in terms of, let us say, on one side we are seeing RBI facilitating a lot of policy-related changes to induce and to facilitate there could be a meaningful transaction which can come through. On the other side, we are seeing that the companies that themselves which were not able to operate are slowly getting into an operation kind of phase. So let's say once you are able to showcase to an investor that yes, a lot of these issues have got settled, then there will be a fair value which can come through as far as the deals are concerned.
I mean, what percentage of the M&A activity that we're seeing right now is stress related? And how much is conventional in your assessment?
From a sector point of view, I think 50% of the deals are actually happening in the technology side.
Right.
Okay. And followed by financial services, which is about 13%.
What about deals happening via capital coming from outside the country? That has also kind of picked up quite a bit, right?
So yeah, that much is very sure, Prashant. We see the inbound activity as really there's been an uptick on that. And largely because companies are far more having a positive outlook on India. The favorable regulatory changes, the forward-looking government policies, sort of a relaxation on FDA norms in sectors like aviation and multi-brand retail, and the GST coming in, all have actually sent a positive signal, and the outlook has been positive. We see a lot of inbound activity happening, at least in the last 6 months, and that's a good thing to happen, And we see that in pharmaceuticals, we see that in consumer discretionary space, as well as technology.
In your sector as well, I mean, I think there are structures now being created which allow for that kind of thing, right? I mean,
yeah, absolutely. I think there is what we have seen over the last couple of years is that there has been interest in terms of foreign investors coming in and either partnering with some local existing developer, and then so we have seen a couple of those transactions happening, and I think the kind of opportunity which is there in this particular sector is pretty humongous. But at the same time, the issue with the infrastructure sector is that it's highly capital intensive, and being a capital scarce as far as availability is concerned. So what we are seeing is a lot of pension funds and other long-term capital providers are ready to partner with either an Indian developer or, let us say, an Indian stakeholder who can then take up. So those kind of partnerships, so we are seeing the funds coming in through various means, either directly from an existing developer who are ready to take the bets, or through a financial investor who's ready to back an Indian promoter or Indian group in terms of partner as far as this consolidation is concerned. So I would say that over the next few years you are going to see a significant activity, especially in this particular space.
And just to add to what Pramod is saying, the GST being a very transformative legislation, we expect to see a lot of traction in the logistics space, because with supply chain networks had to be reconfigured. So logistics is one area where we can see a lot of deal activity going forward.
Okay. If I can ask you a simple basic question, what are the tenets that actually make a deal work?
People are looking at both profitability as well as the scalability. So these two things are very central from a workability of a deal point of view.
Would you like to add something to that?
Yeah, I think there are two parts. Anybody looking at an M&A will definitely look at scale or diversification or integration. But to actually get a deal work, I think first there has to be willingness of the parties. Second, I would say a critical factor is the trust factor, because that we have seen a lot of deals either getting not done or not done primarily because of the value systems involved or transparency during the entire process which comes through. And the third would, of course, I would say is the quality of the team that you put together and the kind of diligence that you get together and how you analyze the data also has a lot of say in terms of how you go ahead and consummate that.
Sure. I mean, so once the deal is done, merger for example, post-merger activities, do you think enough attention is paid there? Or what advice would you have?
60 to 65% of the deals do not realize the intended synergies. And there are many reasons, and I think primarily it is on account of diffused people and technology related integration. So I suppose these are two things, where when you get into the deal, the post-deal, how effective are you in sort of realigning the people side as well as on the technology platform. So these two things are very vital, and companies now actually are looking at post-deal integration play as part of their deal investment. So clients are saying that, look here, we need to know what exactly, how we're going to understand, how we're going to exactly do the post-integration. And that gets built in. And companies who do that well are more successful.
They're able to actually realize whatever they thought out in the first place. Mr. Menon, Shiv, thank you very much, both of you, for joining in. Thanks very much for watching. On the other side of this break, we have another very interesting discussion coming right up. Welcome back. You're watching PwC The Winning Leap. Taking the discussion on the deal scenario in India forward, I have with me Sanjeev Krishnan, leader private equity at PwC, and Gopal Jain, managing partner at Gaja Capital. Gentlemen, thanks very much, both of you, for joining in. Sanjeev, if you can start with you first. Last year, that is 2015, we saw about $17 billion as far as PE money into the country is concerned. Do you think this year we can top it?
I don't think so. I think we'll end up somewhere between 10 to 12 this year. I think if you see last year, there was a lot of money going in early stage companies, a lot of money going in consumer and technology based companies, early stage companies, which is not happening this year. I mean, that money is not available, those investors are not there, and unfortunately some of these businesses have not held up to the promise that the investors perceived last year. Aside of that, there are obviously sectors which are doing well. For instance, financial services is doing very well, healthcare continues to have significant interest, consumer continues to have interest, and renewables and real estate also continue to have interest. So I think we'll settle somewhere between 10 to 12 billion dollars this year.
For us to be a 20 billion a year market, I think two big things have to change. One is Indian alternatives as an asset class has to perform better, and that's linked to the exit question. The second issue is the source of our capital. Right now, Indian private equity as an asset class is completely disconnected to domestic savings. So very little of domestic savings flows into the Indian private equity asset class. Nearly 90-95% of the entire asset class is sourced from offshore investors. But if you want to take this from 10 to 20 on a sustainable basis, you have to connect our domestic savings market to this asset class.
This year and the year next, which sectors will lead PE inflow, according to you, Gopal?
The place to start is actually macro. So, because macro drives everything. And everything starts with inflation. Right, so you have lower inflation, it starts off a virtuous cycle. So what do we have with lower inflation? We have lower interest rates, we have currency stability, and we have equity in general becoming more attractive than before. So as inflation comes under control, as interest rates come down, and as currency stabilizes, as equity becomes more popular, you will see again a rotation into domestic consumption. So domestic consumption driven businesses will start becoming more attractive to investors, start looking more attractive to investors. Also, lower interest rates have a profound impact on attractiveness of infrastructure as an asset class.
Okay.
Right? Because Mr. Infrastructure is actually Mrs. Interest Rates. Right? So what we'll see if this macro improvement sustains is the return of domestic consumption in terms of attractiveness.
Sanjeev, we keep hearing about big numbers waiting for exits, especially out of the infrastructure sector, as Gopal pointed out. He's talking about money going into that sector once again, private equity money. But what about the exits? I mean, just paint that picture for us.
So, I mean, if you look at exits, I think exits, we have seen a good trajectory on exits. I think over the last 18 months, whether it is by way of IPO, whether it is by way of strategic sales or indeed secondaries, I think the exits have shown a good trajectory. It's a good thing because that gives investors the confidence to plow money back, to first raise money and then to plow money back into the country. And, for a capital-starved nation like ours, this can only be good. So I think in fact, the exit activity is great news. The only issue that I see is that not a lot of money which has gone in the infrastructure space is coming out, unfortunately. And I think that continues to be an area of concern.
A lot of global pension funds, sovereign wealth funds, they've started investing into the country in the private space, right? I mean, they've been investing in listed equities, etc. How do you see that trend developing as we go forward?
India is an attractive market in terms of yield right now. So we're living in a world which a very large part of the world is now seeing negative interest rates. And nominal interest rates in India are still high. And as the currency stabilizes, real interest rates right now look very attractive. So the principal direction of fresh interest from these large core institutional investors is towards yield in one way, shape or form. Because even investing in real estate is essentially yield investing, especially commercial. India is not a significantly large market still for large institutional investors to operate directly. You will still see them come via funds. But yes, there's a new asset class which has opened up, which is looking attractive, which is yield.
And what are they really looking at? I mean, because if you take that yield argument and you said, well, some $12–13 trillion yielding negative returns, right? So, I mean, even if a small percentage that decides to not stay in the negative zone, you're talking about very large sums of money.
The relative allocation of capital to India will increase from this very large multi-trillion-dollar pool, given the fact that our nominal and real interest rates are still fairly high. And when that is compared to negative interest rate environments, then starts looking attractive.
So, if we can come to you, do you think many companies look for private equity investors not just for their money but also for guidance, for example, hand-holding? Are we seeing that those kind of deals?
So I think it's changing. I think if I were to look at 2006, 7, 8, I think that was a different period. I think at that point in time, companies desired only capital. I think today also there has been a generation shift, and the entrepreneur today is more amenable to working with the investors. And I think that's a sea change that we have seen over the last 10 years. I mean, if you look at the first wave of investments, big investments, 2006, 7, 8, and the one that we are seeing now, I think that's the big shift which has happened.
Any thoughts on this?
Absolutely. But, you know, it takes two to tango. So in order to provide governance, business domain expertise, and operating value add, private equity firms must be capable of providing that, right? So you on one hand, you need entrepreneurs who are who need that, are willing to accept that they need that. On the other hand, you need private equity firms that are capable of delivering that. And that's where I think there's a profound shift underway in the global world of private equity, especially in India. And private equity firms are increasingly positioning themselves as providers of not just capital, but these kinds of value add. A complete business transformation, a complete business building solution.
Sanjeev, from a regulatory point of view, is everything sorted out, or you think we need better regulation, more tailored to and for these kind of investors and investments?
I think again, I'm pretty happy with all the changes that the government has made over the last 18 months or so. I think all of them have been on the right path, and most importantly, the one thing which sort of I would seek as an investor is there any uncertainty, and I think that's been taken away. Whether it is in terms of the tax regime in the country, whether it is in terms of how I manage some of my investments. There was this huge issue about what's going to happen about my infrastructure investments. Do I get the clearances? So many projects were stuck, etc. So the government has cleared all that up, and of course the big issue on the tax side has been cleared up, etc. We know what we can expect in the future, what an exit is going to be like, because for the investors, and Gopal can talk about it, I mean, it's not just about making an investment, it's about how I can exit it in 5 to 6 years time, whenever the time comes.
So that stability has to be
absolutely
there.
And if I have clarity about that, and I think this over the last 18 months or so, I think we have been headed in the right direction.
As Indians, we must accept that India is still an incredibly tough place to do business in on a day-to-day basis. And the single biggest thing that we can do to make business easier in India is to invest in judicial infrastructure. You cannot have a thriving system of commerce unless and until there is law and order. These are perfectly correlated, commerce and judicial infrastructure.
Fair enough. Just one last question. I mean, when you work with entrepreneurs, and you can sort of give us a few examples as well, how open is a typical Indian business owner when he kind of gets in touch with a private equity or receives money from a private equity fund to put processes, systems, etc. in place?
20 years ago, that we were typically dealing with family-owned businesses. And today, our typical entrepreneur is a first-generation entrepreneur who typically has, best-in-class education. So culture is increasingly defined by education. And this new culture is far more receptive. There has been a discernible shift thanks to the evolution and profile of India's entrepreneurs. But within that, there are always variations.
Gopal, Sanjeev, thank you very much, both of you, for joining in on this enlightening conversation. Thanks indeed.
Thank you.
On that note, that's all that we have for you on the second edition of PwC Presents The Winning Leap in association with CNBC TV 18. Through this series, we've met with stalwarts across industries to analyze and break down vital issues that impact India Inc., from how businesses create value, the strategies and opportunities that are imperative for their growth, and the various challenges they face in India's economic environment. Thank you very much for watching, and do join us for the next season. Wow, that was quick.
Yeah, Ma, don't worry. I'm driving on the new expressway and it's absolutely safe.
Focus, ideate, innovate, enable.